Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And essentially what will happen is option prices will decrease in value. And the reason is that if we look at our distribution curve here, what happens is, again, the market maker has to take the other side of the trade. And in periods of high volatility, basically when option premiums are high, many traders or investors are more attracted to being option writers. So they're looking to capitalize on the high premium due to that increase in volatility, which means the market maker now has to assume the role of buyer and is now buying option contracts from traders and investors alike when the market really is not reflecting the probability or possibility of the security warranting that kind of premium. So what happens is so that these option writers will not be rewarded in periods of low volatility, volatility contracts. And what will happen is where once the anticipated move was between, as we mentioned, between 42 and 58, and then 45 and 55. Now that that volatility has contracted, and the standard deviation, either range plus or minus 1. Has now contracted to 47 and 53. So in other words, the strike prices outside of those range will have decreased in value because the market maker is stepping back and saying, okay, based on the current anticipated move, the movements in these markets, there is a high probability that the underlying security is going to remain within this level. So again, while this all seems maybe a little new and somewhat confusing to folks that are just sort of being introduced to this concept, the main thing to recognize is that it's all about a measure of probabilities and a measure of risk. And even though the underlying security may not be making a move in one direction or another as of yet, there's always outside conditions or circumstances that are impacting the possible value of those securities, and that is what's being reflected within the option premiums. So when we look at how we can use this information from a trading perspective, there's a couple of strategies that we might implement. So first of all, during periods of low implied volatility, call and put options are cheap from a historical perspective. So as I mentioned, as that implied volatility contracts, it now becomes more attractive to be an option buyer because premiums are less expensive than what they were. Now we have to consider also that the underlying security has obviously not been moving in such that it's influencing option premiums to go higher. But keep in mind that, again, under periods of low volatility, these option premiums, calls, and puts are considered to be relatively cheap. And so what this means for the option writer or the person that's trying to generate cash flow using options, they have to essentially write their option contracts closer to where the stock or the underlying security is trading at presently in order to get the premium that they would anticipate. Or in order to get a premium that's worthwhile writing. But for the option buyer, it opens the door to trading various combinations. Now, what I mean by that is that what we can do is we can in fact play both directions when implied volatility is low. We can buy a call and we can buy a put for a reasonable price under periods of low implied volatility. Now, we have to have an outlook such that in the bigger picture, there is going to be a move in that security, but under periods of low implied volatility, premiums become a little more attractive to purchase. And the types of strategies that we would look at would be either a straddle or a strangle. So let's essentially take a look at what a straddle would be. First of all, a straddle is a strategy where we're going to buy a call and buy a put at the same time, and we're going to look at the same pair value. We're also going to look at the same strike price and the same expiration date. So what I did is I just took a nice little snapshot of the chart and some of the different little pieces of information at the fxoptions.com site. And what I wanted to illustrate to you guys, this was actually taken yesterday, so there was obviously some trading today that's adjusted the price of the CDD. But what I wanted to draw your attention to is that if you want to get an idea as to where the current implied volatility is of the CDD, for example, which is the U.S. dollar versus the Canadian dollar pair value, you can see here that there's a little box as you type the symbol in that comes up that suggests that the implied volatility currently is about 11.95. You'll notice that the 52-week high on this particular pair value is 19.55, and then if we look at the low, you can see that it was down around the 10.84 to 11 level. And you know, if you believe that this is a relatively low with respect to implied volatility, you might be inclined to be an option buyer and look for the possibility that on a move in the underlying security, not only will the CDD pair value increase or decrease significantly, but also this implied volatility will begin to adjust higher, giving you a additional profits on your premium as the market continues to move in one direction or the other. So again, we're looking at this sort of implied volatility, the current, the high, and the low, and using that as a determination whether or not it's an appropriate time to be an option buyer. So if we thought that at this stage that there was the possibility that premiums were relatively reasonably priced compared to where they have been, and that there was a possibility that the CDD here was going to make a move either to the upside or the downside, what we might do is take a look at the options market and try to establish a straddle. So in this example, looking at the CDD here, if the CDD is pair value is sitting around at around 107, we could go out and we could look at a March 107 call option that is valued at $1.90. We could also look at a March 107 put option that is valued at $1.50, and we could pay a net cost of $3.40 per contract, or per straddle to participate. Now remember that we need to make sure that we're confident that this particular pair value has the ability to make a move beyond the net cost of our premium. So we need to make sure that, as I said, we're confident that the analysis that we've made warrants this kind of a trade. But let's say that we felt that there was some overhead targets up in and around the 115 level, or on the downside we might see the pair value trade back down to par. At the end of the day, we can establish a position using a put and a call option, pay a net debit to our account of $3.40, and create a scenario where as long as the underlying moves, we're going to profit.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.